high interest rates. Why are you paying more today? Hello everyone and welcome back to another episode at NOVARISE. And today we're going to talk about mortgage interest. Yes, I know it is not a surprise. Everybody knows that the interest rates are high today. But that's not what I wanted to talk about in this episode. What I wanted to do is to share the reason as to why they're high. And yes, it has to do with the Fed, but that's not entirely all of their fault. So without further ado, let's just dive into the details so that you can understand better what's happening in the economy, what's impacting those rates, and what you can do about it. And then towards the end, what I'm going to do is to share a couple of tips here and there that I've been implementing that has allowed me to continue to buy real estate in spite of the high rates. So let's get started. So first things first, before we dive into the reasons as to why the rates are high or not, let's just first take a look at the current inflation rates, because I know this is a topic that has been tossed around back and forth, but I wanted to put things into perspective to help you visualize and understand what has been happening over the past 12 months. So this is a chart of the past 12 months, and each of these numbers represent the inflation rate. So as you can see, the Fed did in fact achieve its goal of reducing the inflation rate over the span of 12 months. So we started off with 8.3 sometime last year, and then you will see that it slowly started decreasing. So we got October over here with 7.7, and then January 2023 with 6.4, April 2023 with a 4.9, all the way down to 3.2. So I know that when you compare July to June numbers, it might seem like there was a peak, but I mean, we don't know what might happen in August. We don't have the numbers for August yet, because in order for that to show in this chart, remember you have to give it at least 45 days. You have to wait for the entire month to come to an end, and then allow somewhere between 10 to 15 days for economists to pull this data all together and publish it in websites like these for you to check out. So as of today, at the moment of this episode recording, we don't have the August inflation numbers, but this will serve as a good benchmark for you to compare these numbers in a span of 12 months. So now it's time to move into the nitty-gritty, and let's take a look at this amazing article filled with information courtesy of the Wall Street Journal. So as we start scrolling down, we are gonna get a couple of things here and there that will provide us details about the market updates. So mortgage rates pushed to a fresh 2-decade high this week, making it tougher for the housing market to emerge from a start slowdown. The average 30-year fixed mortgage came with an interest rate of 7.23%, according to data published Thursday by Freddie Mac. Some borrowers are paying even loftier rates. The rate was 7.09 a week ago, its first time above 7% since last fall. The new high is a turnaround from 2 years earlier, when borrowing rates were below 3%, near record lows. Millions of people were rushing to buy homes and refinance. Now, I want you to put a mental pin right there at this last sentence that we said about refinance and people buying home at low rates, because we're going to get back to this eventually. Now, back to the article. Financing a typical home purchase costs hundreds of thousands of dollars more in interest. Applications for purchase mortgage dropped to their lowest level since 1995. The Mortgage Bankers Association said this week. Existing home sales fell for the 4th time in 5 months in July. So those are the updates of the market as of today. Now we're going to transition into learning why is this impacting your mortgage rates? Why are you having to pay higher rates than years ago? So back to the article, and let's scroll down and look for that section. The biggest thing to understand is that lenders don't usually hold on to the mortgage they make. Instead, they look for investors to buy them. So just to elaborate a little bit more, let's suppose that you saw this house for $350,000 and you went to this bank, the bank around the corner, let's just call it that, and asked them for a mortgage. So they said, yeah, sure, we're going to do that. Let's just work on qualifying you and do all the paperwork, and you can come back and close in 45 days, right? So you come back in 45 days, they will give you the money, you sign all the mortgage documents, and voila, you bought your house, right? But It turns out that things don't end there because banks are in the business of making money. So bank around the corner will want to continue to repeat that transaction because those repeat transactions is what's going to make them make money right from the get-go. They don't want to wait 30 years for you to repay that mortgage and slowly make interest back. They want to make as much money as possible today and continue to keep the ball rolling. So in order to do that, what they do is that they originate the loan, they compile all their money available to give you that mortgage. And then after you sign on that mortgage, what they do is that they take that same mortgage, they package it and sell it at a discount to other investors to come in. Why would they do that? Well, they will sell it to investors because investors will come in and give them a lump sum of money, and they will have money again in their accounts so they can repeat the process and issue new mortgages. So they do this by the bulk, they do this by the volume. That's why they say that most banks usually don't keep the mortgages in-house. They sell it to continue to keep the ball rolling. This is the reason why after 6 months or 12 months of you purchasing a home, you will receive a letter in the mail saying, hey, nice to have you as a client, but we decided to sell your mortgage. From now on, you're going to pay your mortgage to this person or to this institution. You will no longer pay us. And that's in essence what you get to see in the front, but I just explained you what happened in the back end. They sold the mortgage and now you continue to keep your mortgage, but this time you will pay a new person, a new investor. Now, back to the article. Selling mortgages comes at a price though. Investors want to earn more for taking on the risk of buying mortgages compared with the super safe treasuries. Lenders also have to cover their own cost of making the loan. And as of today, there is a lot of uncertainty about the economy and interest rates right now, which means that investors are demanding higher yields to compensate for it. There's also less demand from key investors for mortgages. The Fed, which purchased massive amounts of mortgage bonds during the pandemic as part of its effort to stimulate the economy, has bought virtually none over the past year because it is shrinking its portfolio. And there you have it. That was the key answer. So investors are not buying those mortgages. And the investors can be people like you and me, but that's not enough to move the economy around. In order for the economy to flow the way we expect it to flow, we need bigger buyers like the Federal Reserve or other private banks to come in and buy those mortgages by the bulk. But what happens is, as you saw in the article, is that the Fed is not even buying these mortgages. They're actually trying to get rid of them. And what happens when the Fed or any other bigger institution stops buying for the mortgages? There's not enough liquidity going around in the banks, and therefore the banks need to figure out another way to make money, and that's you. And because of that, you're now paying the higher interest rates. Historically, the way it worked in the real estate investing business or even with the mortgages is that you request for a mortgage, and typically the rental income that you get from that should be enough to cover everything, to cover the mortgage payment, the admin costs and stuff like that. So that same analogy is not different from the investors that come in. They purchase mortgages at a discount and they expect to make money off of it. But when you're dealing with higher interest rates, that means higher costs for the investor. So in exchange, they demand higher rewards, but the rewards are not there. One, because the rates are too high and it's eating into their profits. And also there's not enough volume of mortgages being originated because one, there's not sufficient inventory available in the market of houses for people to buy. And two, there's the issue of affordability, which makes it a little bit difficult for you to even qualify for financing when you see rates that are very, very high. And so when you combine those two together, it makes it very difficult for people to want to, let's say, pull the trigger and say, yes, I'm ready to sign off my life away on a mortgage. Or for investors to say, yeah, let's just continue to buy mortgages in the market because, hey, it might pick up in the future. No, they need to see a constant stimulation, a constant movement of those mortgages. And unfortunately, right now, it's not being shown in the market. Like the volume of mortgages originated has actually dropped. So it's kind of like a ripple effect, right? So unless they see some movement in the market, the investors are not going to continue buying, especially the Fed. Now, back to this article, we see that banks would also plow their extra cash into mortgage bonds when rates were low, are now trimming their holdings, wary of keeping along duration securities on their balance sheet. Again, even banks are trying to get rid of those mortgages because they don't want them in the balance sheet. Silicon Valley Bank had a big portfolio of mortgage funds, which hastened its demise in March. Now, I know that the topic of Silicon Valley Bank, it's a lengthy one, and we're not going to cover that today. But if you are interested in truly learning what happened with them, here's an episode that you can check out to continue to expand your knowledge about the subject. Moving along with the article, mortgage-related security holdings by banks and credit unions fell 7% from a year earlier in the first quarter, according to Inside Mortgage Finance data. Regulators started to liquidate tens of billions of dollars in mortgage-backed securities from SVB and Signature Bank in the second quarter, adding to supply. As you can see, more and more banks are actually liquidating their mortgage holdings, and that means there's plenty of those mortgages floating around in the economy. And you know what happens to the economy when there's too much, prices go down, and where there's not enough, prices go up. This is what's happening with the housing market. There's not enough inventory for people to buy, and therefore housing prices are also up. That, coupled with the issue with interest rates, are making affordability a lot more challenging for some people, and therefore that also deterred investors from wanting to buy mortgages, and therefore that translates to mortgages being more expensive for you because you have to cover that out of your pocket now, because there are no investors buying those mortgages and helping you reduce that interest rate. Now, what can you do truly in this market condition? Does it mean that your dream of owning a house or becoming a real estate investor is over? Of course, you still can buy properties, but you have to do it in more creative ways. And I actually have a couple of proposals from the Wall Street Journal. And then towards the end, we're going to discuss what I have been doing that has allowed me to continue to buy real estate, even in this current economic situation. So here is another article, courtesy of the Wall Street Journal, what 7% mortgage rates mean for home buyers. We're not going to go through the entire article. I just want to point out two sections, right? So the first suggestion they have is to downsize your expectations. What do they mean by that? That the house that you buy today doesn't have to be your forever home. I know this is not ideal. I know that a lot of us are dreaming with that bigger house with the extra bedrooms or like having all the amenities that we currently want. But circumstances have changed, and maybe this is not the time to have that dream house. But what's important is, can you still afford to get a house? By that, I'm not saying just buy any house, but maybe you can make some compromises in getting a smaller house. And that way you can still afford to purchase a house. You park your money in an asset that will continue to grow over time. And then maybe in 2 to 3 years, you can choose to either sell the property and use the proceeds to buy the dream home that you want to get, or just simply take out a cash out refi and use that money as a down payment to buy that property that you so much wanted to buy. So downsizing your expectation, really asking yourself, is this really necessary, or is this more of a luxury? And if you can come to terms with that, maybe that's one way to be able to enter the real estate market. The second tip the article is suggesting is that you should focus on the monthly payments. And what do they mean by that? Is that you have to be very careful with what you buy, because if you buy a house that you cannot afford, then that means you could end up house poor or possibly losing the property to a foreclosure. And you really don't want to do that. What you want is to run the numbers with the help of a professional mortgage broker, if necessary, to get an idea of how much your monthly payment will be. And your monthly payment needs to be at a comfortable point so that you don't have to cut down on your basic necessities. The idea is to strike for a balance of becoming a homeowner and still be able to live comfortably, not luxuriously, but comfortably. So those are their two suggestions. To recap, one, reset your expectations, not necessarily think about that dream house that you want. Yes, I know it sounds kind of unfair, but is it really that bad? No. What you're going to end up with is maybe a house that is slightly smaller than what you originally wanted, or maybe with less of the amenities. But again, remember, at least your money is not losing value because you're parking that in an asset that is going to grow over time. And then eventually you can either choose to refinance out of the existing loan and lower your rates. That's what I would do. Or you can just simply choose to sell it and use the proceeds to buy another property. Or you can just simply choose to refinance, also a route that I will take, and extract the additional liquidity or the equity that you have built in the house over the years, and then use that money to buy another property. Now, one of the things that I've been doing to buy real estate is to negotiate the rates with the mortgage brokers. So whenever I see a property that I like and the numbers meet my investment criteria, I ask my mortgage broker, is there something I can do in order to bring down the interest rates? And typically what they're going to do is to offer you the chance to buy points. And in fact, last month I was able to close on some properties at 4.75 in spite of the current high rates that we see on the market of above 7%. So that is possible. You just have to work with the right team member, with the right mortgage broker, and just ask around and get the right rate for you. So that way you can also make the numbers work for you. Now, for those who are actually interested in learning how to negotiate the rates, here is a video that you can check out. And for those who are ready to jump into the adventure of buying a house or becoming a real estate investor, here's a free webinar that I pulled together. And all you got to do is just to sign up and watch it. And in that webinar, you're going to learn how to run the numbers correctly and pick the right property, the right investment property for you, so that you can grow in your finances even in today's market conditions. I'll see you at the webinar. Take care. Bye-bye.